PowerOptions suite of tools, and we'll use, of course, these tools to illustrate the points on your questions. And let's see here. First, I just want to mention what we're looking at, of course, is the 14-day free trial. For those of you currently on your 14-day free trial, make sure you take advantage of the 4 steps here. Free quick start guide, flash tutorials that are available to help you with the tools. We have a variety of archive webinars and free webinars during the week that you can join us. And of course, trial members and subscribers can schedule a free coaching session at any time. All right, I have some comments come in that during this market, it looks like Sam's been doing bull puts and straddles. Straddles with bull puts or straddles even on earnings for Facebook, Disney, Lulu, Microsoft, CVX, and more. And directional trades in the marijuana stocks. Is looking at the strength there of the QQQ and NASDAQ as well. All right, let's see here. Good. Okay, so just had a few questions coming in. I'm just scrolling through real quick. All right. Okay, so we've got Lewis, Daniel, and Sam's comment on his expiring options. We got Thomas, Daniel, and Luis set to go. So Thomas, you were first. Thomas is asking a question about a trade on Netflix. I can't give direct trading advice, but we can take a look at your position and see what you've got. What do you think of the following trade on Netflix? Buy a 340 put and sell a 300 for July expiration. All right, so let's go to the custom spread tool on PowerOptions to build this on the fly, and then we'll use some of the other tools to further research and analyze the position. So what this structure is, looks to me to be a bear put debit spread. We are going to buy a July 340 put and sell the 300, okay? So right away, my thoughts here is that this is extremely risky but low cost. Why is it risky? Let's take a look. You put in, Thomas, that you're buying that 340 put and selling the 300. Okay. This is going to cost us roughly $765 with a potential 40-point return. If we're doing one contract, it'd be $765. And we have the potential that if the stock is trading all the way below 300 here, it didn't draw it well for us because it's out of the money. It's quite all right, but the trade would go on like this. This is a bear put debit spread where we sold the lower strike and bought the higher. Okay. The goal of this trade, of course, is for the stock to be trading below 300 at July expiration. If the stock's trading below 300, what happens? Well, we've bought a 340 put, which gives us the right to force someone to buy shares of stock at 340. And we have an obligation, if the stock's below 300, to buy at 300. So we'd get 40 points back minus our initial debit. The max return would be $3,235. Why did I say it's risky? Well, it's risky based on the sense of probability. Even 3 months out in time with a bearish if you have a bearish speculation on Netflix, I'm not sure I'd bet against Netflix right now, but if you've got a bearish look at Netflix, we want the stock to fall. There's probably just a small probability, probably I'd say 22% probability that the stock will be trading below 300 at expiration, July, in order to receive the maximum profit. Now, break even's 332. It's right about here, right? So, but the stock's at 374, so we'd still need 10% decline just to hit break even in the next 3 to 4 months, 3.5 months, no, 3 months, 2.5 months. I'll call it 2.5 months. How about that? Okay, so let's just look real quick. So now that I'm looking at the custom spread tool, I want to get some other things here. As I mentioned, we know that the max profit occurs in July if the stock is trading below 300. When all time value is out of the positions, we've got the intrinsic value left. So what I can do here is looking at the short option itself. I'm going to use the more information button. Just go to research and option research first. And I was way off. The probability the stock will be below 300 for the maximum profit is only 12.3% to July expiration. Of course, you got a very low delta here, other situations. So it has a powerful risk reward, if that's what you're looking for. Meaning in that sense that you're looking to only risk 765 to make 3,235. But you have such a low probability of getting that amount. You have a higher probability of losing 100% of this. Of course, if you held it all the way to July expiration, because you need the stock to fall quickly. And you need the stock to fall 70 points, almost a 20%, more than a 20% decline, well, about a 20% decline, of course, in the next month and a half. If I wanted a better risk-reward ratio and I was bearish on Netflix, rather than put both puts deep out of the money for this extraordinarily high percentage return, what I may consider doing is maybe going out to June, but if we stuck with July, 84 days out, you might want to try a debit spread where you're straddling the stock price. In other words, maybe doing the 360, and you were doing a 40 points, it'd be up to 400, but let's do a 30 point, 360 to 390. In this case, you'd sell the lower again, which is out of the money, and you're buying the higher, which is in the money. And so in this case, we have a better probability. You're putting up 1477 for the potential to make 1523. It's a 100% return, and you're probably at a 40% probability of success rather than a 12.3% probability of success as well. So those are my thoughts. We've talked in other webinars, of course, that the debit spreads are the only ones I would use that are around the stock price. I would never do this with a bear call credit spread, which is a parity trade, because the short call, if I sold the 360 call and bought the 390 for a bear call credit spread, the short call is starting off in the money. I can be assigned at any time. A debit spread structure around the stock price is one that you would use, but I think you're taking on too low of a probability for too high of a return trying to set up that 340, 300 spread where you need almost a 20% decline in 84 days to realize the maximum profit. And you need the stock, as we saw, to be below 332 in order to hit break even. I think that's too much of a risk to try and take for looking for a high speculative return. The probability reflects that. The higher the return to risk ratio, the lower the probability of success. And we saw that bear out with only a 12.3% success probability in this case. Okay. Well, let's see, here's this next one. Let me just scroll through very quickly, see if we have any comments here, okay? Okay, Sam made a comment not related to this. A short-term option, long sideways is not working in this type of market. Okay, Robert, I see your question. I'm just scrolling through here. Right, and this is what I was going to get to next as far as Sam says. So we talked about Thomas's speculation on this Netflix Bear Put Debit, okay? And we saw we needed a large decline in order to get to the break even, a much larger decline to reach the maximum profit. Normally when I go to the charts here, I have it saved. I'm just going to put in my quick indicators real quick. I'm going to look at a standard SMA 20. Sorry, folks. And we're going to look at Bollinger Bands, of course, and the MACD as well, and RSI. Now, I put volume in there too, but I'm not going to worry about the volume right now. So this stock has been condensing. Recently, looks like it had a positive MACD crossover, and the RSI is increasing. Although it's pulled back towards the 20-day moving average here, it's bounced off of it and came back up a little bit today. I know you're projecting outwards 2.5 months to 85 days, but right now, looking at the chart with a positive MACD, until I saw a negative crossover, saw the RSI declining, or saw this drop below the 20-day and the SMA 20, excuse me, and the lower Bollinger Band, or get close to the lower Bollinger Band, I wouldn't expect to see a bearish trend right now. It's bouncing off support a little bit. Let's go 6 months. Yeah, see, so it's up near this high again, and it's holding there. Could it pull back to this lower level of 240? Maybe, but it's been on a strong run recently, other than the news from Disney, which didn't seem to affect it too much, even though it's hitting a new 52-week, well, it's not near the 52-week high, I apologize. That's at 423. So if it continues this trend and it gets a little bit more strength, it's more likely that it could probably go back up to 400 before it drops down to 300. Anything can happen. One other thing that I'd want to check here is that you're thinking about going out to July, excuse me. And let me just take a look at the stock here. I haven't seen recently. Okay. So right before expiration, you'd have an earnings. Well, maybe that'd be a bearish trade. Maybe that would cause the stock to drop, but I don't, depends where it is at that point between now and between expiration. Now, the good thing about the debit spread is that you won't be too far behind when you open it. It's 85 days away. If it's not going in your desired direction the first 5 or 10 days, you could probably liquidate the debit spread for a small loss. But I think it's too far out of the money. I think it's too speculative, in my personal opinion. I think the probability is too low, and I think that's just too big of a move to expect. I'd rather perhaps fight a bearish notion to just straddle the stock price rather than put everything way down to get that overly unbalanced risk-reward with only a 12% probability. Okay, you own the June spread and you rolled it to July. Okay, so just in general, yeah, you rolled it there. That's good, but I still think it's too far down to expect a bearish trend. In the short term, maybe if it's not looking like it's going down, it's not looking like it's moving down in price, you might be able to augment or counter some of the loss you might taking on that bear put debit stead as it stagnates, maybe by doing short-term bull put credit spreads following that trend as well. Okay. Okay. And Lewis says, why not just sell a naked call if you are sure of the direction for Netflix? Well, it's probably because that takes on an infinite risk. The debit spread gave us a low risk. If we're wrong, we can only lose the debit, Luis. Whereas on the naked call, if we're wrong and it starts to go up on that, it doesn't follow our trend, then we could end up with significant losses. We'd have to carefully watch it and put a stop there. I'm not a fan of doing the naked call positions. I know in many markets they can be profitable as well in that case. But I don't like the naked call idea because if you're not sure of the direction, or even if you are sure of the direction, hey, if I'm not sure and I think it's dropping to 300, I'm probably buying a put rather than doing that. But that's not my direction. All right. Okay, Daniel asks, how does the RPM perform the radioactive trading strategy? How does the RPM perform during the not so good previous years in the market? Direct answer is very well. Well, very well. It is a bullish strategy. Okay, so in markets like 2008, it didn't have profit. I didn't have personal profit in my radioactive trading techniques. I had stocks that were down 25 to 30%, and overall, I only lost 4.5%, I believe, that year in the radioactive criteria. And on average, I'm making 12% on mild, well, I'm sorry, 10% on mild years, 9 to 10% on mild years, 12% on the investment into the radioactive trades to 15% on the good years. Okay. So that's the limit losses. There wasn't a thing with covered calls in 2008 or in bad previous markets where I had to wait another 2 years for things to recover to where I was back to where I was before the decline started. You may have seen the pen position that we talked about before, where during the declines of October through December here, I was in a married put position, but following the rules and doing another married put implementation, I ended up, of course, profiting on a position. And earlier that year, of course, we also ended up taking a, well, let's just take a look here. Let's just take a look. Let's see here. And you can go through some of this, Daniel, at any time, even though you can't see the specifics. You'll see the specifics. I'm just logging in right now to radioactive trading. Give me 1 second. Oh, by the way, there's just letting everyone know, there's a potential for heavy thunderstorms coming through my area within the next half an hour. So I don't expect to lose power, but if we suddenly cut out, that's the reason why. I just heard a little bit of thunder, I think, so I'm just letting everyone know that. All right, Daniel, I'm going to the track record here, and I'm going to view track record. So you can do this. This is mine, of course, but you can go into the track record, not logged in, not as a member, and you can see some of the basic information. And what I was talking about here on the pen position was I opened it on October 2nd, 2018. And with proper use of the income methods and shortly into the trade, I used a certain income method and an adjustment, got out of the position in the month. The stock fell 32% during that 1 month and 4 day time period, and we were able to profit 10.3%. You know, see, not all of them are profitable. This one dropped 30%, sort of missed it, took a loss of 2.8. The Sony position was my fault. I sold the call too soon, and the stock just shot up 10% when I had the call open, not related to earnings. So, you know, you can go back in time here. Let me go back to page 3 for you. Are we close? Oh, no, not even close. Let's see other times here when the stocks are doing bad. Here's a bad stretch, 11%, only lost 4%. And profiting here at different time frames. A couple others have the profit when the stock fell as well. Trying to go back to the beginning. Yeah, here's one here that where I wasn't in 2008, 10 years ago, on Office Max, where the stock fell 68.3% and I made 1.9. Not every position is going to be profitable. And of course, just because it's a hedge position, you don't usually make as much as the standard stock increase as the stock moves up in price. But again, the idea behind it is that when you do lose, you can maybe even profit or only have a small loss as well. So long term, by the way, you've heard me mention before that probably for the past several years, 5 years, no, probably 7 years, excuse me, my portfolio has consisted of about 50% of money allocated to the 50% of the money allocated to options is the limited risk radioactive trading techniques. You saw that performance there. Okay. And then probably another 15% is in 15 to 20% is in bull put spreads following the bull put weekly screens. I do have numbers on that for you as well. I did that during a coaching session this week. We talked about the numbers. It's an unfair advantage really to look at January to now. We looked from January 1st to April 25th because everything was up. The bull put weeklies following that trend of opening every Monday afternoon, taking the top 3 trades, it's a 93% success rate. Well, just about everything is going up. So that wasn't fair. But even last year in a bearish market, the bull put credit spreads, had I traded them through the entire year, would have still had double-digit profits and an 83% success rate. So that's another 15%, and I'll do a couple diagonal spreads with usually about 4 to 5 month out long calls and short-term calls against it, 2 weeks out to 3 weeks out usually on the short term. And then I'll play some strangles in my portfolio. Where I was going with that is that I've traded covered calls for an extended period, tried to do call buying and put buying. I've done calendar calls multiple different ways in multiple different cycles over the 15 to 20 years I've been trading options. And long term, since I've been trading the married put radioactive techniques for 10 years, overall, you know, not just looking at a snapshot of 2018, not just looking at a snapshot of 2017 where the bull puts were much better percentage-wise in my portfolio, but long term, the married put percentage performance has outperformed anything I did in covered calls, calendar spreads, bull put credit spreads, because there were terrible losses that would have occurred if I was trading those strategies through 2008. Would have switched and done bear calls naturally at some point. But even people who were trading bear calls got hurt in 2008 because the first part, remember there was those days where it spiked 500 points down, then 500 points up, 300 points down, 400 points up. What was happening? You're getting stopped out every morning. From a bullish trade to a bearish trade, trying to change direction, and you're getting hit, a trigger's getting hit every morning when the market opens. So that was really, really difficult to try to be profitable on leverage spread positions at that time, even in some of the other years, later 2015 and later 2016 as well. But this is just chugging along, okay? And it's even outperformed the standard collars in my portfolio long term. So to answer your question, you can see that in the track record, as I mentioned, even if you're not logged in. You can take a look at the performance there as well for the radioactive trades and what had happened over time also. But again, it's meeting my goals still more than other positions and other strategies. Crap. Okay, there we go. And so that's what we tend to look at there. All right. So again, I was just showing you there some of the positions. There's that one from 2008 that was down 68.3%, made a profit of 1.9%. And of course, here we are with that position here, the 33% decline in 1 month on Penn, which was a 10.3. You know, other positions showing a loss here, but we limit the loss with the structure and still able to take profits on some of the others as well. Okay. All right. So now I would never say, as much as I trade this, unless you're at retirement and you're not a day trader and you're at retirement, I personally wouldn't say, Ernie would, but I personally wouldn't say that the radioactive trading techniques should be 80%, 90% of your portfolio. I would never say that. But the core holdings, the core building, what you're trying to build in your portfolio, if you're trying to use dividend paying stocks, if you're trying to use high volume stocks that you're getting from other services for long-term buy recommendations, this should be in my opinion, it should be the Mary Put approach in radioactive trading, which so allows you to trade actively as far as doing adjustments on this position. Okay. So it's outperformed that. Now, again, I had mentioned quickly about the bull put weeklies. So let me just go back to big charts real quick, and let's do a quick custom time frame. And we're just going to do 1/1/2018 to 12/30. We all know what happened last year. Okay. So the Mary puts I had last year, buoyed up by that Penn position a little bit, but more, was my return for what I had invested in the radioactive trading techniques was around 10.8%, I think I had. I'll look that up. I can't remember where I put it, but it was about 10.8% over the year. Just for that time frame, the positions that were opened within 3 weeks before January 1st and the positions that were closed within 3 weeks after this was around 10.8% return with radioactive techniques in a market that was technically down. Okay. But again, there were opportunities here to profit and make money. And I was fortunate enough to I got burnt. Let me go back. On the bull put credit spreads that I used for 15%, 20% of my portfolio, I had 3 open on February 5th through 9th, right? That's that volatility crush. And then here we have that March, here it is, March 21st through April 5th decline. Little hiccup in June, but not bad. And then that big drop here in October, the first one in October. So here I took about a 70% loss on 2 of the 3 bull puts I had opened and close to a 50% loss on the other one. I rolled it out, actually, which I don't normally do. But I ended up rolling the third. I just took the losses on these. Didn't have many losses here. Was still far enough out of the money, but lost on another 2 here. So even though this trend, this 5.5-month period was up, and it was almost a 93% success rate at this time period for the bull put credit spreads, I stopped trading after these 2 losses and waited until mid-January to start doing bull puts again. Okay, but I did lose on these 2. But with these 2 losses, small loss in here, and these losses here, the bull put credit spread still outperformed the married puts by about 2 to 3%. Year before that, the bull puts outperformed by a lot. 2017, we were straight lower left to upper right. We had almost a 94% success rate on the bull put credit spreads. So it outperformed the married puts, but it didn't in 2016. And keep in mind, too, what we see here, you'd say, oh, well, you should be just doing all of those bull puts then and not the married puts. Even though this ended up with about a 12.5% overall return had I traded it all year, even in a down market, a market that did end up down from where it started, okay? The bull put credit spreads had a fluctuation where if I looked at it for just the year, at this point, the portfolio, the amount of money I had allocated to bull put credit spread trading was down 52%. At this point, it was down 58% because I didn't have enough to make back. I was, making 10%, 9%, but I was started down 50%, and then it came back up. And then it went down again. So it was a little bit more. We were down here about 58, 59%. Normally it'd stop. But we kept going with only 1 or 2 positions, then 2 to 3 positions back, and then we got hurt again here. But overall, it ended up at 12.1, 12.2%, I think it was. Okay, higher than the married puts, but at one point it was down 58%. Oh, and by the way, I'm sorry, at September here, 9 months in, it was up 28%, right on target for what we'd think with a leveraged spread trade over a course of 12 months if we kept the success rate. But then that happened. And I didn't trade it all through this, okay? It stopped in October after those other 2 losses there. But that's why whenever someone says, well, if you did so well in 2017 and you did so well even this year in a down market with the weekly bull put credit spreads you have, why not do that with 50%, 60% of your portfolio? Because at one point, the money allocated was down 60%. I don't want that type of swing monetarily in my portfolio. I don't want the risk of going bankrupt in that situation in that case. Okay, so that's how it relates to that. That's why I still do what I do. I know there are investors that are more successful than I am with their portfolio size and what they're doing. The strategies they might be trading. Sam has been doing extremely well when he's been offering his comments about his spread positions and trading some of the marijuana stocks. Doing some of the straddles with spreads in between from other webinars, and that's fine. Everyone has a different approach and everyone has their own personal goals. This is how I've been able to meet my personal goals. All right, Robert, that's a fantastic question. I'm going to get to that, but again, we were going to Luis was third. Okay, so Luis asked a question, and I can't do it on this account, Luis, simply because your third question. I'm sorry, Luis. Your third question here. Can you set up a 16 delta trade short strangle with Tesla and then use the history tool? I would like to see it in action. Well, I could show you how to set it up, perhaps, but I can't. This is just a trial account that we use for the webinars. I want to leave the custom spreads up there. So I don't have more than 3 months available, okay, for the data. So I'm sorry, short strangle. Okay. Now, the short strangle criteria, I don't think has a delta that it doesn't have a delta filter right now that you're looking for, where I can put in the delta sum, okay, on the position. But what I can do, now I thought I had something here for the individual deltas, and that's what I was looking for, but I don't see it on this one. Maybe it's on the straddle. Okay. So I can probably force it, but let me do this first. What I would do is clear it out. Now, the one thing you don't mention, you said that you wanted to see a short strangle, 16 delta. I don't have the delta filter to do on this. Okay, I can kind of fake it with this. So it'd be probability between, I think, of greater than 91. Try that, and I want a probability sum. I'm going to say less than, I want to say 10, but I'm going to push it up to 15. And now you'd have to select your expiration. I'll just go standard May expiration, for example. Okay, and what I'm going to do here is just now, I'm going to create a stock list to do this. That'll be the easiest. All right, so rather than just use the fundamental screen, I'm just going to use the stock list. So I click on create and modify lists. We're going to create a new list here. Well, the name is going to be the same, TSLA, TSLA. All right. Okay, so let's created that list. Let me go ahead and close that and refresh the page here. Oh, shoot. That was my fault. It reloaded. It's okay. Take 1 second. So I'm going to try to force the delta we want using this lower range probability. Actually, I think I could probably go to 9. I don't need to worry about in or out of the money or anything else because I'm just looking against one particular stock. All right, let's run the search real time now. And let's see here. This is something. Oh, there it is. Got it. Call delta, put delta. 1 second. So I'm sorry, I went to the see more or less columns, adding in my call delta and my put delta to see how close I came with those numbers or what I need to change there as well. Okay. I should have moved it, but we'll keep it there. There's a 12 delta, there's a 10 delta, there's a 12 delta, 8. Okay, so I might be too far. Might be too far. So I'm going to do this. I'm going to put the probability sum at 8 to 15. And I put the probability between to be 88 to 95. I'm just going to restrict it a little bit more. Let's see what we get. 16. So sorting it this way, 15, that's closer. That's what I want. Okay. Turn of 1.1% based on the margin. Now let me save this real quick as our TSLA short strangle. Just want to really look at the top two. Okay, so now that I've saved it, of course, what are we going to do? Under short strangle, let's go to backtest. Let's go to smart history. Let's go back as far as I can, February 26th. Our Tesla short strangle, submit. This is not a strategy that I do advocate or do trade in my personal portfolio. We're just showing how to use the tools there for Luis. Okay, so 14 delta, 12 delta, 13, 14, not really close to 16. Oof, sorry, just heard something drastic outside, sorry. All right, so the top 15 of 18 results, close to the delta you want. Let's go ahead and just check here. These were from March, from February to March. That calculate group results is going to show me how each of those ended up. And all of them from February to March ended up full profit, I believe. That's, I think, expected the full profit with the margin requirement we have for a short strangle, 0.8%, 0.7, 0.6. Okay, and then so since I don't have the full testing here, I could do now is do the same thing, but let's go to March. And we hit expiration on March 17th, so we'd run it again on March 18th. I'm sorry, 15th of March, not the 17th. That was the days remaining to expiration. So we hit the 17th, expiration, we go forward. Now this is interesting. Nothing matched that criteria on March 18th. Let's see if we can go to the next day. And it's probably not building them because the premiums might have been 0. If it sees an option bid of 0, it might not build any new positions. So I'm not seeing any from March to April. Let's open this up. Let's go 0 to 20 and 80. We'll go 80 to 95. I don't think we'll get the 16 delta you want per se. Yeah, these are too high. These are in the 20s, 22, 23. Yeah, those deltas are too high. So let's get this back again. Let's go back to 5 to 20 and 85 to 9. So I'm just playing with numbers. Let's just try to get back to where we were. See if we can get it where we need it to be. Yep, closer. 19, 19, 18, 17. Closer, 16s. All right, 8 results. Let's do it. Calculate those group results real quick. So you had 100% success rate, average around 0.7% from February to March. And from March to April, I apologize if this takes a long time because right now at the end of the day, the system is uploading all of the history. And these at the time would have given you 1.3, 1.1, so an average of probably 1.2% return for those 8 or so ones with the 16 delta. Okay, so that's how you can do it if you have the historical tools. We're just going to look at 2 months there to move on, but you can set up the search as I showed. It'll give you a starting point. Probability sum limit at 5 to 20, probably an 85 to 95% probability. Of course, different market conditions are going to change that, right? As volatility increases, you might be able to get a higher return there, without getting that higher position. Okay, all right. All right, so, okay, 45 to 60 days to expire. Okay, so Lisa, you could make those changes too. Just select all expirations. I just did one with that. Select all expirations and go 45 to 60 days. All right, Sam says, why trade Tesla when there's so many nice stocks going up in earnings and one can easily make money to be a bullish market? Well, you know, this is one of those things that I don't do, that a lot of investors like to take a look at. And a lot of investors follow one or two or three positions. So ones that you've been tracking, ones that you know, might be Tesla, might be Netflix, it might be something else along those lines. And they go bullish or bearish. And I know you do this too on some things as well, Sam. That's perfectly fine. I think that's Luis's approach. He's doing other trades as well, but I think he's trying to gauge how could he best trade Tesla to maximize premium but have the highest success rate. Or he saw a webinar on it, or someone earlier said that they had seen a spread mentioned on CNBC's Trade Picks or something along those lines. And he wants to see how it would work. What are the... Sorry about that. Large thunder and a little bit of clap above us. So had a flicker in the lights there, but power's still on. Some of you had commented earlier, I apologize that the screen had frozen. I think it actually had kicked me off briefly with a lightning strike and a loud thunder that came through, and that's why the screen was paused. It actually blinked in me for a second, then came back, but I think it automatically put the screen to pause, and I didn't notice it. I click on that after we had moved the screen. But in any case, so if I get distracted next time, it's just why. All right. Pause for a moment. Let me see here. Scroll through. Okay, so I've got John's question still waiting in the wings. And we've got Robert's question as well. I'm just scrolling through. And as Sam says, this trade in SPY is similar to the Netflix, but it's a little different perspective. Okay, so let's talk about that again, okay? All right, good, good. All right, so John is a member of RadioActive Trading and the Fusion Service. And John wants to know, and John, I apologize, a few weeks ago we had you had asked me specifically about the IM number 12 on Penn, and I have not been able to locate the blog article or the video that we did. Greg remembers me sending it to him to post, but we can't find it on any of the computers, so I'm redoing it, and I hope to have it done for you early next week for Fusion members and Blueprint owners, sort of the insight into the income method number 12 that was used in Penn. That was the way that we took that 10.3% profit with the stock falling 33%. We were long stock the entire time on that radioactive trading position. But the follow-up question here is related to a newer position I opened. John asked me about earlier in the week, and I haven't done anything with it. And so it's on semiconductor, and this position was opened on April 9th, and I bought the stock at $22.77, and I bought the January far out in time 25 put for $4.20. Okay, so it had an initial risk of 7.3%. Now, let's go to the custom spread tool. The reason John was asking me about this position is because he followed me into it, I'm assuming. But earnings are coming up on Monday. And there are ways that you can do certain things with the radioactive trading techniques to potentially profit in both directions heading into earnings. There we go. And potentially earn income without capping the upside. There's a lot of different things that you could do. So here's my position with the 7.3% risk, monetary risk of 197. This is out to January. Normally, I don't like to talk about specific income methods for the radioactive trading techniques that are only taught in the blueprint. But I'll show you, I'll discuss with you briefly three things I consider, John, why I didn't do them. Okay? First off, the stock's at 22.44. It moved up above, the day after you sent me the email, I think it moved right above 23, maybe 23.25, 23.50, and I thought about doing something then, even though my put's at 25. Then it pulled back down. So we're 33 cents down on the stock, and the put is almost at the exact same price. The bid's 410, ask is 430, so it's still at 420. The first thought is, well, I'm coming up to earnings. I've got a 7.3% risk on the position. And we know the worst case scenario is the stock could fall 20%, or it could gap 20%. Doesn't happen that often, but that's really the worst case. So what am I going to assume here? Let's assume functionality of the worst case scenario. And let's say a 15% decline or a 15% move. Okay, more than 10, which is probably more than expected. 8%, 7% is usually realistic, even with the good earnings, but we'll see. So let's say a 15% decline. So the stock's at 22.44, or even when it was at 23, but let's just take it now. It's at 22.44. So a 15% decline would put us about $3 down at 19.44 on, let's say, the 30th. All right, so what I want to do here, I want to go to April 30th, and $3 down, so let's say it's at 19.50. Okay, it drops 3 points. What would my loss be on the married put position? That does not look great. Oh, never mind. Wrong numbers. Let's drop it down to 19.50 properly on the stock price. Okay. So with the worst case scenario, and it could get worse, but look, at 19.50, I'm at a loss of 159. Not quite near the maximum loss, but still pretty big. Okay? But I still have, with doing nothing, John, I still have to January to make adjustments, take the profit off of this put, set up a different structure, see where my thoughts are in this, or even profit if it continues to fall. Not a problem. Now, on the opposite end of the spectrum, I apologize. What happens if it goes up 3 points to 25.50? All right, so in this case, we'd be looking at a gain of roughly 104. Okay, so loss of 159, not quite the max loss with a 15% decline. 3 point close to 15% increase, we're at 104 profit. Okay. Now, one thing I could have done, it wouldn't have done anything for me. This is part of the reason why I didn't do it, John. I paid $420 for this put. I could sell it. Usually it was around $410, $415, $423, and as low as $390. I saw it at one point during this week. But I could sell to close it right now for $420, which is a wash. Okay? But what I was thinking about doing is doing income method number 3 before earnings. I could bring that put into May or to June. Okay? So I bring the put into June. I keep the 25 strike. Well, I sell to close my initial 25 put, get nothing back for it or slight loss, and buy to open a June 25 put, which would lower my risk to 3.2%. That did cut the risk in half. But now there's only 65 days left on the trade. Yes, it's a lower price. So again, what would happen if our stock went to 19.50? Oh, volatility of 0.35. To keep it fair, okay, let's go ahead and calculate that. All right, so this would be a much lower loss of 82. Okay? In the worst case scenario, fell down that 3 points, and if it moved up, this is after doing income method number 3, the bulletproof vest, bringing the put closer in, but I didn't get any profit, John, out of the original put, which is why I didn't do it. It was a wash. So all I did is have a cheaper put in place. And hit calculate, and the profit is 74. Less of a loss, less of a gain in either situation, but if the stock only moved up to 23, it only gains 2%, 1% for the earnings. I'm still at a break even or a slight loss on the position, equal to where I am now without doing anything, and I only have 65 days to try to make profit on the position. For me, this did not match the SIGA model, did not match what I wanted to do with this position. Now, you were looking for the potential of doing something else, doing something extreme. that, not extreme. I don't mean to say it like that, John. But you were looking for, hey, I followed you in this trade. Earnings are coming up. If it falls, I want to see how you're going to profit on it. And if it goes up, I want to see how you're going to profit on it. So you were probably hoping I was going to do something fun, like I did with Penn. Or you're thinking, Mike should do something like he did with the Penn trade. So if there is that 15% decline, he could take a profit to the downside. And if it jumps up 15%, he can still profit as well. So the consideration there was doing a short term, adding an extra cheap put, let's say the 20 for the price, and then, doing that income method number 6 position to help pay for it. So I buy a May 20 strike put, which sort of puts me in a synthetic strangle. And I fund it by doing income method number 6, the bear call spread. I know this is confusing to some of you who aren't familiar with it, but what it does is I get 30 cents here that completely covers the May 20 put, the price of the May 20 put. And if the stock falls, that's still part of the strangle, right? So what happens here? If the stock falls, this just keeps going to 0 because I have 2 puts and the stock. And if the stock fell, this bear call spread would expire worthless. And if it gaps up, I still have unlimited upside. Where's the problem? There's 2. At $19.50, this is still a loss. Okay, it's not a loss of $159, but this hasn't kicked in yet. Okay, this put protection, the extra put protection won't kick in until we probably get down to about $19.10 per share. I'm sorry, $18.10 per share. I'm sorry, $18.10 per share. And on the upside, I don't start to see a profit again. It does this double dip back into the loss, and I don't start seeing that profit again until probably it's above break-even number 2. That's the third one. The break-even third one would probably be at 26. Oh no, probably be at 27 even. Where's the problem? Remember, we were expecting at 15% at the most, gap up or gap down. I'm still at a loss and still at a loss. How does this help my position in the structure? It doesn't. I took a chance. No, I didn't take a chance, but I evaluated all 3 adjustments. The only thing that might have made sense to me was rolling the put in so I could have a lower loss if the stock falls, but I'd also have a lower gain if the stock moves up because it's such a shorter term put option now. And during the time when I looked at it, John, I would have taken a loss on the initial put, which would have put that upper break even rolling into the May or the June put from January higher. So of all the things I could have done, all the things that were standing out there, I didn't like any approach that put me in a better situation, I felt, than just leaving the position alone right now, and that is what I did. Okay, so that's what Fusion traders see. I didn't post my thoughts on this before earnings. I looked at all probably 2 other evaluations into what we just saw that I could have done, and they did not match my SIGA model because the benefit of doing it did not outweigh the fact that if it does go a 15 or even almost a 20% gap up or gap down, I don't profit. Why take that chance? If I was comfortable with the risk of only 5 or 6%, if it falls 20% and this is at a 5% loss, I can just take that and move on, better than in most situations. Or I could simply readjust the position after earnings and set myself up for a structure to profit if the stock recovers or if the stock continues to decline after it shows me its hand. I felt it better to stand pat because I didn't like the analysis of the other positions. One other thing, of course, we could have done, I just showed it, but if I had just did that bear call spread, the income method number 6 on top of the existing married put, it would have lowered the loss a little bit by about 30 cents, taken us down to 6.3, left the upside open if and only if the stock gapped up to 26. If it stayed in that no zone range between 25.47, roughly that 15% increase we were looking for at 25.50, to about 27.10 or 27.20, I'd still be at a loss. Okay? The adjustments sometimes, they're very useful, they're very helpful. They could be very profitable. They can turn a losing trade into a winning trade, bulletproof the position and more. But why force an income method or a combination of income methods, even with earnings coming up, if the opportunities don't quite match what you want to see for your expectation on the position. Okay. That's, oh, John says you've on as well. Okay, so those are my thoughts on why I didn't do it, and why I didn't come across anything that looked good, that wouldn't, cap the upside too much or move in that direction as well. Okay. All right. So let's see here. Just scrolling through real quick. Sorry for the clicking noise. Here's a comment going back for Sam, and this is from Luis. Luis says, someone asked why Tesla, and it is not about Tesla, but rather about verifying my hunches with the history tool. I've been making most of my money since I joined Power Options by just using the Strangle tab and the short put tab. Okay, from Power Options, I find it best to trade neutral and get out once you make 20-40% on my positions. It's good. I'm glad to see you're not staying in those strangles too long, that you get once you make a profit. So far, it's been a profit and loss of 76%. All good after getting small losses, trying to find out how to structure the trades and do the adjustments. Very good. That's great, Luis. I'm glad to see that. I'm glad to hear that it's been doing so well. Okay. All right. All right. And John says, thanks for your walkthrough. Learned how to do this for myself. Appreciate your logic. And my decision was to do income method 13 as well. It's a joke. I have income method 13 of the 12 different income methods taught in the blueprint. Income method 13 is do nothing when nothing matches your goals for the position and expectations moving forward. All right, and we'll see how this turns out on Monday, and then we'll have further follow-up on that as well. But again, that's what's available in the blueprint, is not just the structure that we use for the limited risk, which you saw there on the ON position that was open on April 9th, but the 12 different adjustments we can use in different markets or for different expectations. And one of the ways, of course, that you saw there is how we used that pen position to still profit 10.3% on the position in a month and a half, being long stock the entire time and the stock falling 33%. And that's all available in the blueprint. And, of course, both Johns, there's two Johns here that are following the on trade. Both of you are probably going to get that video on the income method number 12 for Fusion members and Blueprint owners next week, early, probably Tuesday, maybe Monday, and we'll see what ON does. And of course, all Fusion subscribers will get a follow-up on that in addition to what we just saw today of why we didn't do anything, and then what are we going to do when ON happens. All right, we're going to change gears now. Fantastic question by Robert. I like how this is structured, the question structure. John wants to know, what are your thoughts on buying a deep ITM 80 delta call on SPY and selling short-term monthly calls against it month after month to generate income? Advantages, disadvantages, and challenges. Okay. First things first. Good. This is a calendar spread, or more commonly a diagonal spread. Similar to how I trade it, but I don't just trade on one security. I look for securities that match my criteria, which are actually pretty close to this. So there's two things I want to mention about this first. Number one, regardless if you're looking at just SPY, but you are Robert, and we'll take an eye to that, or if you're just doing the diagonal spreads where you're buying a deep in the money 8, 10, 12 month out call and selling near term out of the money calls against it, gives us this sort of profit and loss chart. Some people refer to it as a poor man's covered call. And I don't want to go too in depth on this, but in recent webinars you've heard me say I do not like this term. They were calling it a poor man's covered call because instead of spending, $280, $290 to buy SPY and sell a 300 call against it, I'm buying probably a 240 call for January or December expiration and selling it for a cost of maybe only $30 to $40 and selling a same 300 May call against it. So they call it a poor man's covered call because you don't have to buy the stock. And they say, hey, but you can make leverage returns of 15, 20, 30%, where a covered call you'd only make 1 or 2% on the same security. But if the security falls 4, 5, or 6%, 5, 10, or 15%, you could be looking at losses on your spread, on your investment into the spread, of 10, 20, up to 40% with a 15% decline, maybe even 50%. The leverage works both ways. I don't like the term poor man's covered calls because investors who got used to covered calls or understood covered calls but only had small funds say, I want to do the poor man's covered call. They get too caught up and then they fail to realize that you can actually lose more percentage-wise than you could on a covered call position. Stock falls 8%, you generate 3% return, you're at a 5% loss. In a diagonal, stock falls 8%, sure, you got 15% against it, but your long call is down 30%. If you didn't practice proper position sizing, you're getting hurt more in the poor man's covered call than you would in the covered call. And it's too many people do that. You say, oh, I don't want to spend $280 per share. I want to spend $30 for the leap. But hey, why don't I buy 4 contracts so that I'm only putting in 120, half of what I'd be putting on SPY? And then you get a 60% loss, a 40% loss on that leap. Yeah, you invested 50%, but you lost a factor of 5 times more than you would have on the covered call with that 8-10% decline. Okay, that's that. Remember that. And I know you know that, but that's the risk. That's why I don't like the term poor man's covered call and how it's taught that way, because I think it's getting too many people into trouble because they assume it's just as easy as covered calls, and it's not. And you know why it's not? Because you're not dealing with a stock that has a 1 delta and you know exactly where it's going to be. It is going to, you're dealing with 2 options that have 2 different movements, okay? And 2 different deltas and how they react and interact with each other. And I'm going to talk about that a little bit more in depth right now. All right, so let me go to the calendar call, and I'm going to try to go to search by symbol first for SPY. And I'm going to craft a position that matches similar. Let's just go to, we're still going to call it a leap. All right, 267 days out. I want more results here. And we're going to use May against it, standard monthly. I was afraid of that. Didn't like that. Okay, let's go to the search here. Clear it out. So this will help me filter it better. I'm just going to May. And 21 days. I'm sorry, I'm just going to do this 20 to 22. And let's go to January. Okay. And I want my long option delta to be at least greater than 0.80. And I probably want a delta ratio to be greater than 1.6 if possible. Short call is going to be out of the money, right? Yeah. Out of the money near call is just 0. Let's go percent out of the money greater than 0. Option bid, yeah, definitely greater than 10. No, we're going to go greater than 20. Okay. Let's see what I... Oh, and then fundamentals. My apologies. Okay. There's another filter I would... There's another filter I would have put in here. Let me just build it on the fly. Problem earlier with this I saw. I think this is because the history is being updated. I really apologize for that. My guess is probably here. Okay, so we're going to go with a 280 for the time being. Give me a second, folks. I'm sorry. And let's just go May. Standard 17th. Yeah, so all of the things I mentioned about the risks involved with the leverage and calling it a poor man's cover call. Someone just commented and they've heard it called the fig leaf before. 300 might be, see, we're at 293 now. 300 is not bad. But if I'm paying for that higher delta with 23, probably at least want $1. But I want an even strike. We'll go with the 297. Not that far out of the money. You're probably more comfortable with the 300 in this case, Robert, but it's only 50 cents or so. All right. Okay, so in any case, first things first, I have to make sure. What do I have here? I have a 17-point strike difference on my spread. This is one of the reasons why some results didn't appear, and this is one of the reasons why I wouldn't trade this one in particular. Look at my debit. I'm paying $23.82 for the leap option, and I'm getting $1.27 back for this out-of-the-money near-term 297 call. My total debit is $22.55. My difference in strike prices is only 17. This is a no-no. One of the filters I always use is on the search for calendar spreads is the debit to strike difference ratio. A debit to strike difference ratio. And I always make sure that this is less than 1. Meaning what? That my net debit is always less than the difference in strike prices. Why? If there's a sudden move in SPY and I'm in this diagonal and the stock goes up here, and you look at this position on the calendar and you say, hey, I'm still at a profit. You're not. This profit and loss chart is based on the theoretical value of the leap option at short-term expiration. But if the stock gaps up suddenly and you get assigned early on our 297 call, what is your broker likely to do? Well, either you're going to end up being short stock, right? That's the obligation of a naked call if you don't own the stock. Or most likely your broker is going to buy shares of stock. You're going to exercise your long to buy shares of stock at 280 to sell at 297, and you only get 17 back. This profit is based on the theoretical value of the leap option at short-term expiration. Anytime you're in one of these diagonal spreads, you want to make sure that you're in a position where you don't want to get assigned early on your short call, because you want to be able to sell to close this option. You want to be able to sell to close the long option because why? It still has 8 months of time value remaining. If you exercise it at 280, you're missing the other 10, 12, 5, $8 of time value that's still there. You want to be in a position where you can, if you're getting out of it, where you're selling to close the leap to take the time value you still have. If you exercise it, you just get intrinsic back, no time value. Okay. Yeah, and Jonathan's comment there was called it a fig leaf. Did you say a fig leaf? The long dated leap somewhat covers you. It does. All right. So we do have an obligation to buy shares of stock at the price. But again, in this strategy, you don't want to do that. You are covered. You don't have to put up the margin, Jonathan, to do that in that situation because it's covered by the long. It's just a diagonal spread. I don't care if someone calls it a fig leaf or a poor man's covered call. It's a calendar spread. It's a diagonal calendar. But whoever wants to use what marketing term, go ahead and let him use it. But I just don't like that term poor man's covered call. And again, why? Remember what I said here. We have a cost basis into this position of $22.55. And what happens if we have a 10% drop in SPY in the first month? $29. Okay, let's just call it $30. It drops down to $265. Close to it. Let's say it drops down to $265. Okay, it's about a 10% decline from where we are now. And it happens midway between now and short expiration. And let's put in a volatility average of these two around 0.10. What's going to happen? Oh, why did that refresh? Sorry. There we go. You paid $23.82 for the leap option, and the theoretical value of this option is $472. You lost $1,900 on this leap because the stock fell 30 points. That makes sense, doesn't it? 30 points, about half of that, a little more than half that's lost on the leap. But what is that? No, seriously, what is, let's just do the math real quick here. I'll do it off screen here. So, 1,910 divided by a cost basis of 23.82, that's an 80% decline in your investment. Yes, you make the whole 127 back, hooray. But the long option is only valued at 472. A 10% decline in the stock, 30 points. A little bit more than 10%, okay? But it's, about 30-point drop, a little bit more than 10%. If it happened within the first 7 to 10 days, you're expecting a 70 to 80%. This goes on with John S.'s question. This is poor man. Been there, done that. That's partly why I'm happy with the radioactive positions, because this can hurt you, okay? Now, it's talking about a sudden drop. That would be a significant drop on SPY. There'd be a lot of things going on in the market for a 10% decline in just an 8 to 10 day period. But we've seen it before, haven't we? February 5th through 9th, March 21st through April 5th. I'm not saying it's going to happen, Robert. I'm not saying that's going to happen. You asked me what to be aware of. This is what you have to be aware of. And Sam chimes in again, as he always does, to remind you that this is why position sizing is key. Even though you're putting up less than 1/10 of the cost to get into the stock, to do this leap spread with only one contract, Don't double or triple or quadruple the size, because you can see 60, 70, 80% loss on that value. It is a leverage spread. And even though you have a delta of 80, which as the stock moves up, the leap option should be gaining 80 cents for every dollar the stock gains. If it falls, it's the same thing. You start to lose about 80 cents for every dollar the stock drops, then the delta will drop, to 75, but you're still losing. But remember, leverage. What's 80 cents off 23.82 versus $1 off of 293? The leverage works both ways. You got to remember it. Never, in my humble opinion, I don't know if it's worth a salt to anyone who trades diagonal spreads with more of their portfolio, has been trading them longer than me. Never enter a diagonal spread where the net debit to enter the position is greater than the difference in the strike prices, even on SPY, because of that risk of early assignment. In this case, you'd only get 17 back. If it suddenly shot up to 300, you got assigned early. Your broker, without your commentary, without verification needed from you, they need to cover this obligation in the short call. They exercise the leap at 280 to sell stock at 297. You get 17 back. You're at a $500 loss when you thought you'd be at a profit of $300, $400, $500. Shifts in volatility is another thing to pay attention to. You look at a position. I enter this position and some bad news comes out. SPY stays about at the same price, okay? But some fear of something overseas, geopolitical, comes out. And my short option implied volatility goes up to 0.18. And all of a sudden now it looks like it's going to cost me, without the stock even moving, it's going to cost me $1.87 to buy to close this call that I received $1.27 for. So I'm losing 60 cents on the short call, even though the stock really hasn't moved. And this is staying the same. Why? Because fluctuations in short-term volatility are more likely to affect your near-term option as opposed to your far-term option. This is going to react more slowly. That's another trick that comes into play in this, Robert. The farther out options, January 2020, January 2021, if the stock moves up if I entered this trade, and on Monday SPY moves up $1 exactly, I should expect this to move up 80 cents if I had an 80 delta. Okay, I should expect it to. But it wouldn't surprise me if it only moved up 50 cents. Why? Because the far out option is not as affected as the near term. This might go up 40 cents and this might only go up 50 cents. Right? I thought I'd be at a bigger profit with a 1 point move, but I look at it after the first day and I say, wait, how did I only make 10 cents? The stock moved up $1. I should have lost 40 here and gained 80 here. I should be up 40 cents. This option will lag. Okay, so the second day, if it's still trading around that same range, it'll go up maybe another 30 cents to have that 80 cent gain. It's not going to be as instant as the reactions of this shorter term option. That's not really a necessity to be successful in the spread trade. We're using the diagonals, the poor man's covered call, the fig leaf, whatever you want to call it. I just mention it as one of the finer points that when you're watching the diagonal spreads, you can't expect day by day to base it on delta and see the return you expect, because your leap option will lag. It'll eventually catch up, but it's not going to react as quickly as your shorter term option. Okay, so those are sort of my thoughts. I use this in my account. I use it almost with the same structure you're talking about, Robert. I'm going 6 months out to maybe 8 months out. I look for a delta probably around 0.7, 0.8. I do it on stocks, not just on SPY, not just on an underlying, a single underlying. I change based on the criteria. I never open a position where the net debit is less than the difference in strike prices. I kind of look for that delta ratio of 1.6. I can see why we didn't have any results. It wasn't matching that. And also, the debit to strike difference ratio for a lot of these spreads wasn't there for what I would want. Okay. Position sizing is key, just like anything else. Okay. Anything else. But we'll put credit spreads, bear call credit spreads, anything along those lines. As Sam mentioned, position sizing is key because of that loss you can suffer. 10, 15% decline in the stock. You might have a 50, 60, 70% loss on your long leap position, which is your investment. All right, Robert, so real quick, as we're at 5:44, I still have a couple of other questions to follow up with. We'll be here till 6 o'clock Eastern time tonight. Real quick, Robert, if you haven't done so already, going to the free webinars page, remember, you can access it at any time, powerop.com/webinars.asp. There you go. It's a public page under the option strategies. Scroll down a little bit. Sorry there. And from last year, 2 years ago, my apologies, calendar spread basics, defining horizontal versus diagonal, proper structure, specific terms, what to look out for, avoid goals and expectations for each structure. What's a horizontal? A same strike spread. More like a butterfly, something I don't do. I do the diagonals, Robert, as you mentioned, to mimic a covered call, but I just don't like the term poor man's covered call. And then, of course, here we have the follow-up webinar, calendar spread criteria, underlying stock, criteria set up for the proper structure using a weekly or the monthly. Now, what do I mean by weekly? I mean, if you're trying to sell week by week against a 4 or 5 months, or if you wanted to go with selling month by month and buying the leap as well. So those are there for you to look at over the weekend, Robert, get some more insight, and then maybe schedule a coaching session, or as always, give me a call next week. We can talk about some of the information you reviewed in those webinars, what other thoughts you have regarding the diagonal spread / poor man's covered call. Okay, so going in order here, the Sam's comments, Tendum is in my portfolio. It's one of the marijuana stocks he was talking about. I was along with CGC. Binh, Michael, I have an Apple position which I acquired at 230. What is the best way to protect profit when Apple releases earnings next week? I think we reviewed this last week. I don't think it was for your position, Binh. What you should do is go to Married Put tab. Go to Insurance and put in your position. All right, what the insurance tool does is it's going to show you what puts are available. Okay, so you're already down. I'm sorry. I thought, wow, I've read that wrong. I'm sorry. I was reading 130. I'm sorry. You put in 230. Okay, so you're at 230. You're down 230 already. So what I was just doing, cost basis is too high. Well, you want to protect it, so you may just want to buy a cheap put. This doesn't necessarily get you to profit if Apple falls. I think Sam said you were bullish on Apple. You had a position that was more bullish on Apple for next week. A Strangle, I think you said. You had a Strangle. So I don't know when earnings exactly are, but you might want to go out 2 weeks in time. They're kind of expensive, but you might want to buy just 1 or 2 cheap puts. Why 1 or 2? Why 2? Well, if you buy 1, you're going to add a cost base of about 10%. I'm sorry, 1%. 1% to the position. And so you'd lock a loss into a max of 5.5% on the position. If this, no, you're at 230. I'm sorry. Very sorry about that, Ben. All right. So this is probably it. So you're already at an unrealized significant loss of about 30 points. All right. And about 15%. Now this costs another 1%. So you'd cap your loss at 16% if the stock really crashed and fell below 195, 185. If it drops below 195, you could also sell to close the put to hedge what you're already losing on the stock. Get some of those points back in that sense of a decline. Now, I'd mentioned you could buy 2. Why would you ever buy 2? Well, in case it really falls, now I'm adding 2% cost, $426 against $204. The loss steepens. Right, we go to a loss of 16.8% if it's right at 195. But if it really collapses 50 points, yeah, I don't think it would do that. I don't know if you'd want to do this. It'd be better just to hold it at the 16% if it falls. And if it falls further than 195, you can roll it. And if it moves up more than 2 points, guess what? You made back what you paid for the put with the unrealized gain, okay? Now, there's something that I wouldn't do. When someone contacts me, Ben, and says, Mike, how can I manage a position? I got stuck in at Apple at 230. It's at 204. I'm down 26 points, more than 10% from where the stock is now, but about equal to 10% from where I started. Well, we would talk about the signature tool there. We would talk about the stock repair tool, which builds ratio spread potential for you to help you get back to break even faster. All right, so we'd be doing a ratio call spread potentially. Let's do 100 shares. You would potentially be doing a ratio call spread. See, there's some repairs out for September where you see here, I've lowered my break even down to 214.93 by some combination of the 200 and the 215 strikes. All right, essentially, I buy one 200 and sell two at 215, and I get a 15-cent net credit. Well, how does that work? You're doing a ratio spread where you're buying one 200 call at 14.55 and selling two 215s at 7.35 for 14.70. You only get a 15-cent net credit, but now if the stock's above 215 at September expiration, mind you, when all-time value is gone, you have a bull call debit spread. One long and one short is a bull call debit spread where you could get 15 points back. 214.93 plus the 215 would be 229.93 plus your 15-cent credit in, you're at break even. However, this is the stock repair, and it's very useful to get back to break even. Usually I'd like to see something closer at a lower price. You don't need the stock to go back to 230. You only need to go back to 215. You've cut it in half. But when I click on Analyze Trade, it gives me the profit and loss of this potential stock repair. It is based on the stock going up, not something I want to do in earnings. Why? Because it's still a capped gain. You've done a covered call and a bull call spread. So if it goes back up and it goes to 220 or 230 after earnings, you've got a max profit of 15 cents. You're at break even, but you're not at a profit. You'd have to close. You could get this back from the bull put, but then you have to pay a few dollars to close this 215 call. Now you might be right back where you were at square one. So to protect it in fear of the downside, look to buy maybe that shorter term May put, maybe the June. You will dial in some of the unrealized loss already. You can't fix that. You could buy two puts, of course, to profit to the downside, but you're going to need a much more significant decline than is likely, that is probably likely with Apple at that time. In addition to that, as we did before, back on the webinars page, check out some other ideas, Binh. Go to Options Concepts, and check out the webinar on Manage Your Broken Position, alternative methods for managing a stock position that has fallen in price, a covered call that has moved against you, managing a sold put that is ITM and the stock has been put to you at a higher price, and so forth. All right, so it discusses some alternative ideas, management, using that insurance tool, using the stock repair tool, other ways you might be able to get a lower break even in addition to the stock repair tool and Power Options. Apple earnings is on 4:30. Sam says he's already in the puts. He's going to buy calls for it to complete the strangle. Okay, that's what you said. Gotcha. That's what you said. I'm sorry. Okay. Good. All right. So in that case, Louise says, is there a way to reach out to fellow PowerOpt users? I want to talk ideas. Not right now, but I'll have something for you hopefully by middle or end of next month. Okay, we'll have an announcement there. Sam also comments that I now started doing something different when I buy long. Oh, it's 3 months expiration miss. So you're buying 3 months out, 1% to break even. So buying deep in the money for long calls and puts, and when the stock is going in the preferred direction, I am selling short-term calls or puts for additional income. Yeah. So Sam is, what he's saying is he's sort of legging in and out with a long option that's at least 3 months out and then following direction, moving up and down as well. Fernando, this is, I don't really have an answer to this. It could be a good idea to mount the long side of a poor man's covered call with 50% of the stock. So you have an extra delta of 0.5 and one call delta of 0.3. Well, I mean, we can work different ratios and you can try to find different delta combinations. So yeah, what he's asking there is commenting on is that in the poor man's covered call, you could use a 50 shares of stock, which would technically be a delta of 0.5, and then add a short call for the premium on that. I don't know if it's worth complicating. Honestly, I don't. I like simplicity. I say, and a lot of us see the parity trades. We know that this is a parity to a dynamic collar. That SPY spread I built where we had the 280, was it? Yeah, the 280 leap call and the 297. That profit and loss chart we saw was exactly the same. Profit and loss chart, not percentage and not monetary. It'd be exactly the same as buying the stock, buying the 280 January put, which of course I wouldn't do because it doesn't match my structure. I'd want to be in the money, but that's okay. And then selling the same March. So I have the stock, I have this. The monetary risk is the same, but percentage-wise, that'd only be about 6%. The monetary gain, if the stock was trading right at our 297 strike, would be close to the same in the dynamic collar with stock plus put and the short call instead of the calendar spread. But instead of being 14% or 15% leverage return, it would probably only be 2% or 2.5. Same profit and loss chart though, but if you do that as well. Yeah, I think what now I think about it, I think Fernando was stating something different, and it's a little different. And yes, I could leave the upside open by doing the bear spread that we saw earlier. We could use 50 shares in the bear spread. Thinking about it this way, I think what Fernando was saying in relation to that is that I think he was saying maybe buy 50 shares of stock and then buy one. I want to be May 10th. I'm sorry. I want to be May 10th. Yeah. But instead of doing the calendar, I think what he was saying is buy 1.3 delta, say the 300, and sell this one. And so you're in a bear call spread with 50 shares. Maybe that's what he meant. See, now I'm just complicating myself. No. I'm selling this one and buying this one. It's a bear call spread with 50 shares. So I have to cover some of the margin, but I have 50 shares to cover half of the margin. And it gives you sort of a diagonal with a hiccup in it. But no. Why complicate it? That's not for me. If that's working out for you, Fernando, that's great. I'm covering half the margin requirement on the bear call spread. I still have a cost of $14,000 for 50 shares. I still have unlimited upside, but I still have this risk. And if the stock fell, what did we say, to 265? Is that what it was? Okay, yeah, it was about 265, halfway there. We're looking at a loss of $1,363, which was $400 less than the loss we would have taken on the diagonal. Okay, so less of a monetary loss, but a higher monetary value needed. Infinite return still, but the profit of 236 if it's at 297 versus what I think we saw 346. So, yeah, this doesn't match my goals. This doesn't match my trading comfort level here, if that's what you're talking about, Fernando. So I don't want to complicate it personally. As Sam said, I might just stay with the diagonal spread as we were looking at and do the bear call. Right, so I don't get the full premium here, but I leave the upside open in that case, but I'm only using the leverage to put up 2,200 instead of 14,000. And it says the idea is to compose delta on the long side in order to have less risk, but at what cost? Okay, how much are you damaging the upside return to do that? You know, and how much does that affect the break even? Sometimes these hedging the delta here to have a lower risk usually results in lower profits. Yes, it's great that you're lowering risk with a delta hedge or sort of a delta mix, but in the long run, is it worth it, and does it still match your goals? My experience for me has been it hasn't. I like to keep the similar structure without overcomplicating it and trying to throw in a lot of extra legs on top of a diagonal spread or on top of a covered call or on top of a collar, for example. I had a coaching session this week where I was talking to a customer about managing a collar position where the short call had gone in the money, and he asked, can he repair his collar by rolling up the call and then adding a butterfly on top of the position? And I just thought to myself, I don't even want to think about what this six-leg transaction would look like. So one of the short calls and the butterfly, the call he would rolling to would be the short call and the butterfly. He'd add a short put and a long put and then add another long call to get a credit. So he's got a butterfly with a short call. How does the butterfly lose? I'm sorry, the short call he rolled to would have made up the butterfly, and he still got the collar, the stock, and the put in place. And I had to stop and think to myself, how does a butterfly lose? It loses if the stock moves up or down. He's already sold a call once that was neutral and the stock moved above it and he had to manage it. If he's wrong on this one, he's going to lose on the butterfly and on the collar. So it just overcomplicated it to try to repair with extra premium. The risk to reward of the extra legs was not worth it. Now you're doing something opposite, Fernando. You're talking about trying to lower the risk by getting more of a delta hedge by using the shares and the call in that situation for the broad overall position. And that will probably lower your risk, control your risk a little bit more. But I don't think the payoff is worth it, for the extra cost and for the complication. I'd rather see it just be controlled with a put, one option leg, or maybe with a bull put spread, two option legs, rather than worrying about 50 shares of 0.3 delta call and then wondering if there's another premium I can generate on the other side. Personal opinion, if it makes you comfortable, that's fantastic. And I'd like to see more sometime from you via email of how that's working out for you. But for me, just what I saw there, if I structured it right, I didn't like the trade-off. It didn't look good enough to me. All right. Okay. Oh, yes, a Twitter straddle profitable. Sam says his Twitter straddle is probably 39 and a 40 put, which was sold at today's open. I actually hadn't looked at Twitter in months, and I just came across it the other day during a coaching session, customer at a position, and I sort of shook my head. I didn't realize it was all the way back up to the 39-40 range. I thought it was still down at 18-19. I wasn't paying attention at all. All right. Well, ladies and gentlemen, I think that does it for today. I want to thank you for joining me this afternoon. I want to thank you all for your questions, of course. We're going to try to get this webinar posted for you by tomorrow. I don't know if I'll have a chance to tonight, but I'll try to make it work. I just want to remind everyone, of course, today's material are my thoughts on your questions designed for educational purposes, increasing investing performance, and options knowledge. Any of the stocks or options discussed today should not be taken as direct trading suggestions. Options do involve risk and may not be suitable for all investors. Showed you earlier some of the tools today, search capability, a little bit of the historical tools for Luis as well. We looked at the profit and loss chart. We didn't really look at the portfolio today. But remember, you can get free 14-day access to all those tools you saw today and many more. The stock repair tool, the stock insurance tool to protect your shares through earnings. Just go to PowerOp.com, put in your name and email address, and click Start My Trial Now. Don't need any credit card information. You'll have full use of the site for 14 days. After that, our subscription levels start at $40 per month. That's just for end-of-day data. Of course, we do offer services with 15 to 20-minute delayed data, and we offer real-time as well. We showed the link earlier for, of course, the webinars page, powerop.com/webinars.asp. Further information there on the diagonal spreads we talked about with Robert, as well as the criteria. In the options concept section, managing your broken position, and also tools that you can use for locking in gains on a stock you might have an unrealized gain as we head into another busy earnings week, as Sam mentions. Relax this weekend and replace for next week another busy earnings, another chance for profit as well. And also, of course, you can check out our blog, blog.poweropt.com, or you can check us out on YouTube as well. Just look for Power Options, and most of the videos that we post on the site are also available there as well. And sorry, in addition to that, Sam says, this week I had 6 straddles and 6 stocks and all was in the green. Fantastic. My success rate in straddles wasn't so good this week, but I didn't really have a loss. The one loss I had was probably only 20 cents on a $2 straddle, so I'll take that and move on. If you think of any questions later on that you didn't get to ask in today's presentation, or any follow-ups that you had for information presented today, even if you're watching the archive next week as we head into May 2019, remember, send me an email at any time, support@powerop.com, support@radioactivetrading.com. You can also call me during market hours at 302-992-7971. Those of you that are currently on a trial or subscriber, remember, schedule a coaching session at any time. Well, ladies and gentlemen, thank you once again. Have a fantastic weekend. I'll let you know when this webinar is posted and available in the archives and on YouTube. I look forward to seeing you next week as we go into the next trading week and another busy week of earnings, as Sam mentions. We'll see what happens then. Take care, everyone. Good night.